Hello everyone. So this is a post-market analysis for the 24th of September for Nasdaq. Let's start with the daily chart. Okay. So this is for Nasdaq US futures. So starting from the daily chart. So when in the pre-market analysis, what we informed the group and the team was the daily bias was neutral. Why is it neutral? Because we have reached um, these previous highs, and if you look here, liquidity has been grabbed on this candle over here. So because of that, the daily bias was neutral. So we need to wait. We need more information to come up with a daily bias. However, even though the daily bias was neutral, so when the daily bias is neutral, we normally either don't take trades, or if we take a trade, we take it like a very quick trade. We don't hold it for long. So even though the daily bias was neutral, so first thing, for option one, no trades. Option two, you can take a trade, but very conservatively and a quick trade. But we noticed that we are able to take a quick short-term trade. So it will like a bearish entry downwards. So in that case, it's going to be a counter trend on 1 hour and 15 minute, right? But before, in the pre-market analysis, we mentioned that this could be a high risk trade. However, you will see that the trade went well and it played out. So based on that, then if you go into the 1 hour chart, let's look at the 1 hour chart now. Okay, so in the daily chart, you could see the price pushed up from here, and you could see the price retraced a bit. And when in the price push up, we notice there is a fair value gap, 1 hour fair value gap here, and a order block here at this point. So, and then we notice when we draw the fib, we notice that there is a chance where the price could retrace to the 50%, 60 to 70% of the fib. So that was the idea. If in that case, based on that idea of a retracement, fib retracement, if we are to take the price down, then it is going to be a counter trend. Because why it's a counter trend is because if you look at the daily bias, the daily was bullish up to here. The daily bias was bullish, but now because it reached the liquidity, now we are neutral. Even though we are neutral, we were on a bullish daily bias. Now we are neutral. So if we are taking a trade down, so which is sort of a counter trend, even though we are neutral. So, but then the base for the trade was this price leg up, fib retracement possible, and one possibility was to come into the fair value gap, 1 hour fair value gap. Why? Because we can see now the price pushed down, and again the price went up, and again the price tried here, and in that it made liquidity. You can see the sell side liquidity here, sell side liquidity here, sell side. So the idea was, when you see sell side liquidity here and when you see higher highs forming like this, higher highs, if I just draw it in a tool, like if you see, okay, the main price leg from here to here, let's make it so if I draw it again, so you can see the price went up, breaking this higher high over here. Price went up, but price came down. Then it tried again, and it again retraced, and it again tries again. Then it again retraces a bit. So when you see a scenario like this, where the price moved and grabbed liquidity, and now daily bias neutral. However, in the 1 hour, when you see this fib possibility of a fib retracement into a fair value gap, so counter trend wise, like a very quick short trade would have been taking a bearish entry. So that is what we informed the team, and because of the sell side liquidity being generated liquidity on the way up. So if the price to come down to all the way to this fair value gap, it can be a low resistance liquidity run. So that was the plan for the day, which we informed the team and the group. But if the trade is taken, it has to be a quick short entry. That is what we informed in the pre-market analysis. Now let's go to 15-minute and see how the trade went. So when you look at the 15-minute chart, you can see this is that price leg over here, the 1 hour price leg we showed you earlier. But you can see in all this price movement from Friday to Monday, you can see it is bit choppy. It's like in a range in certain places. However, you can see the price reached down and then the price reached up here towards that previous daily highs where the liquidity was grabbed at this point. See, then that daily high, previous daily highs, you can see on yes, on today's trading at the beginning, you could see the price again reached up and price went above that previous daily highs where liquidity was grabbed, and again the price came down. So that was the scenario we could see. So it's part of the narrative as well. So part of the scenario and the narrative is we can see the price is trying to come again towards the daily bias, but then you can see at this moment, if you look at this, there is a market shift down just before the New York op, like before 8:30. You can see a market shift down. So let's go and expand that a bit. So because when there's a market shift down from here to here, so it's a internal market shift which is bearish. So that is going to be in line with our scenario and narrative we explained a little while ago. Meaning then we could think of taking a quick bearish entry. Let's have a look at that now in little more detail. Okay, so this is the same 15-minute chart with slightly more details now. Like, so you can see midnight price open, then price midnight price has been rallying up throughout in the London session, and you can see before 8:30 over here. If I take this, the price came down. So when the price came down here, what happened was there is a internal market shift down as well. Internal market shift breaking down. So from here to here, when this displacement happened, it's a huge displacement in 15 minutes, there's an internal market shift happening at this moment, which is going to give us a chance for a bearish entry, counter trend as mentioned earlier. So we have to be careful. So then we inform this to the team in the pre-market analysis. There is a chance, right, over here. And let's look little more details how the trade went. So now when we see this, we are thinking of taking a trade in the New York session, right? When you see this, you are thinking. And then you can see, then there's a fair value gap made here as well during the displacement. So that's what makes, and then you can see there is order block generate here. So the order block is here. This is the lower candle of the order block, and then here it's huge displacement, and it makes a fair value gap. So that's what makes the fair value gap valid, the displacement, plus it makes the order block also valid because there's a displacement. So one could expect the price to respect this order block and the fair value gap due to that reasons. And also you could see there is some liquidity generated at this moment, which also makes this fair value gap and the order block valid, because when there's liquidity here, and if there's liquidity here going down over here, if there is liquidity, and if the price moves down like this, then there's a chance of price coming and grabbing the liquidity. So when the price grabs the liquidity here, when the price comes here, you can see the liquidity is grabbed, so then which makes this fair value gap and order block further valid. So the probabilities are increasing now for a winning trade. So then in the pre-market analysis, we informed that to the team at 8:30. So we said that in the 9:30 open, there is a chance for a counter trend, quick, short trade. And it worked well. So let's see how we took the entry after that. And then when we were looking for the trade, we were looking for the price. If we are to take a trade at this moment, what is our target? So first target could be these lows over here, right? But however, we can see there's liquidity in this Asia law and the New York PM session law. So there's sell side liquidity residing here. If you look here, so we noted that over here as sell side liquidity. So if we take the entry here, the price could go further down, passing this lower low into this liquidity over here. So that was our target when the trade was taken. And then further we got extra confluence with SMT divergence. If you look at here at 9:15, the Dow was forming a higher high, but the Nasdaq is forming a higher low. If you look at this point, so the moment we see the Nasdaq forming a higher low, now this forms a SMT divergence. But keep in mind, SMT divergence is not the priority. The priority was all the narrative, what we explain up to this, and then we come and look at SMT divergence to see if we can get some extra confluences. So now we can see we got SMT divergence to support our trade idea. So now having SMT divergence makes the trade more probable. And then we were looking at 9:30 to see how the price would react at 9:30 open. And then at 9:30 open, we were looking at the 5-minute, 3-minute, 4-minute, 5, 4, 5, 3, 2, 1 charts. Okay, so let's have a look at that. So at 9:30, when we are looking at the price, our focus is this order block and fair value gap. So when the price is reaching at 9:30, we are looking at how the price would react for this area over here, which is, for that we are looking at 5, 4, let's say 3 and 1 minute charts. So this is that price leg where the 15-minute order block fair value gap is residing, right over here. So you can, so what we are doing at 9:30 is we are looking how price is reacting at that moment. So when we look at the charts, we can see at 9:30 in the 3-minute chart, we can see the price is reacting down more clearly compared to 5 and 4-minute charts. So because of that, we looked at the 3-minute chart. So now when you look at the 3-minute chart, you can see this is that break of internal market shift down. You can see the order block, the 15, this is referring to the 15-minute, and then the fair value gap in this area. So with that in mind, we are thinking if the price is bearish, we are thinking the price should respect this order block when the price come here, right? And then we can see when the price come here, see the price is respecting that order block, and you can see there's a huge push down in a 3-minute. There is a push down here. So if I expand this a little bit like this in the 3-minute chart, so we can see at 9:30 open there is displacement. So that is what we are looking for, and you can see this law is broken with the displacement. So you can see internal market shift happening in the 3-minute chart. So when this internal market shift happens and when there's displacement, and then if that displacement is making a fair value gap, as you can see there's a fair value gap here at this point, and now that 15-minute order block and fair value gap has been respected. So it's fractal in nature. And also you can see that this buy side liquidity residing over here, generated buy side liquidity has been grabbed. And after grabbing this buy side liquidity over here, when the price grabs it and when there's displacement happening like this and the price is fractal, so we can see that it is forming a high probable entry over here. So once we see that, when we see this fair value gap, that is where we would place our entry. At that moment we inform the team that one could place a trade entry here to be without being greedy. You can place your trade entry at the beginning of, let's say, where the fair value gap has been made, because the price is fractal. So this is where you would place the trade, and your stop loss, let's say where we could place the stop loss, and your stop loss can be above this candle which form the fair value gap over here. So you can keep a slight gap from here to the stop loss, and then you could put your limit order over here, and then the first target could you can look at the target in the 15-minute. So to gauge the target, when you look at the 15-minute, you can see your first target can be this law formed over here. If you take this trade, it's risk to reward of 3.89. But as you can see, there's liquidity residing here. You could take partials over here. Let's say if you enter 2 contracts, you can release 1 contract here, take profit, and keep the other contract running, expecting the price to clean this sell side liquidity, which is what happened. Then in that case, it's the remaining will run for a 1 to 5. 5.4 is to reward. So that's how you look into the targets. And now let's go back into the 3-minute chart. So in the 3 minutes, then you put a limit entry and you wait, and then the trade and we entered into the trade. We passed that into the group. Our members entered the trade, and then you can see with all that the price worked well. Once it was having a bit choppy action here, but it grabbed the liquidities, because if you look at the 3-minute, you can also see in the price run up in this area, you can see it in this price run, you can see it generated liquidity. So there is sell side liquidity residing over here and over here as well. So those are important points for us to see when we enter the trade. So we can see the price grab that sell side liquidity here, and the trade went really well. So why the trade played really well is because of all the narrative which worked well, and the price being fractal and the price nicely reacting in a fractal manner. That all plays well, aligns with the ICT concepts. So once you take partials here and the remaining one, and then you exit from your trade. So why don't you hold it long? Because for the reason we discussed earlier, if you look into the daily chart, so why we don't hold it is due to this explanation we made earlier at the beginning of this video. So we have to take a quick trade. Once again, a quick recap of why. Because originally price is bullish, now we are neutral as mentioned at the beginning. So then if we take a trade, we consider it to be neutral but counter trend, so we have to take a quick trade. That's why we don't hold it for long, the trade. So you can see that is correct, because after we take the trade, you can see the price again revert back, because also we had news at 10 o'clock. You can see there was news released at 10 over here. Yeah, but so it came negative for the currency, so one could interpret and say it's positive for the stocks indexes. And then if you look at, you can see at 10 o'clock there's a huge price movement happened. we are not going to really interpret the economic data, but what we expect is a volatility. So we can see that volatility happen, and you could see the price was taken down after that and taken up. One could say that is due to a economic reason or and various other reasons, and still, you know, the price, we are not sure where the price was going to move, as mentioned at the beginning, but that's not relevant for us, because our focus was the trade running from here to here, which played out, and then the rest we wait until market will give us some hints and tips and clues for our next trade. So we are not bothered about that part. Our focus was a clear-cut trade on this part with all the information, ICT concepts being occupied, and that's one thing to keep in mind in trading, because we don't know where the price would go. We are speculators, and we are trying to make a judge solid. We are trying to make a solid judgmental speculation based on probability. And when we look into a trade, we are not looking at the entire picture, like meaning when we take the trade based on the facts up to that point. So we took these trades based on the facts up to that point. And this is happening after that, which is not in our focus for that trade we took. We consider this part for the next trades we are going to take. However, for the day, that was the only trade we took, and this is the recap of that. Okay, so guys, so that is the end of the post-market analysis based on ICT concepts for index futures, NASDAQ. So we'll see you on another video, and until that, stay safe. See you all.